Hello and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we're very pleased you have joined us for our three-day Metals and Mining Conference. Our next presentation of the day is from Cyprium Metals. Please note you may submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for a one-on-one meeting by clicking Book a Meeting in the top toolbar. At this point, I'm very pleased to welcome Matt Fifield, Executive Chairman of Cyprium Metals, which trades on the OTCQB venture market under the symbol CYPMF and on the ASX under the symbol CYM. Welcome, Matt.
Thanks, Greg. And it's really great to be here with OTC Markets. So for everybody listening in, I'm going to be talking today about Cyprium Metals Limited. We are restarting the Nifty Copper Complex. Couple things. One, this is a prolific past producer. It's a brownfield restart. It's copper in Western Australia. We are fully funded, just raised $80 million, and that is helping us drive towards the first phase of our restart. And we expect to be producing copper cathode this time next year. So let's get into it. Today, I'm going to spend about 25 minutes walking you through Nifty and what we're doing there. Take about 5 minutes of questions at the end. So if there are three things that I could have you take away, it's that Australia copper brownfield restart. That would be the first one. This is a great time to be in copper, and it's a great time to have a brownfield. Second, we have a pretty simple plan. It's basically sequentially turn on the different operating units within here. We've got copper cathode coming out of an SXEW plant, 25,000 tons of productive capacity. And then we have a 3 million ton a year mill sitting next to an open pit with 20 years of life next to it. The third point is, again, that fully funded point. We've just raised $80 million. Final tranche closes next week. And those funds are predominantly to bridge us into cash flow. Permits are effectively there. We're waiting on one final administrative approval, which we expect to get shortly. And then it's racing down the track towards production in a relatively straightforward restart plan. So we think that we're one of the most asymmetric risk-reward value propositions on the ASX. To replicate our position would be somewhere well north of $700 million in 4 to 5 years. And we basically have this growth path sitting right in front of us that we're going down today. So on this slide coming up in front of you, you'll see we're in Western Australia. We're about 5 hours outside of Port Hedland. Port Hedland is one of the largest ports in the world, predominantly handling iron ore from the Pilbara. And we are just to the east of the Pilbara. You can see our tenements sit on the map in front of you. These tenements really are the best of the best in the western side of the Patterson region. That is the land of copper. We have the Nifty mine here in red in the center. And then we have Maroochydore, which is one of our growth projects to the south of that. We're in the same neighborhood as the Telfer mine, currently owned by Greatland Gold, and their project Havieron. And then the Woody Woody manganese mine is nearby as well. So being in Western Australia, we have incredible access to service providers. We have terrific regulators and great basis of estimation when we're looking at new pieces of work. So the copper that sits inside this area, it's all sediment hosted. And where you find, typically with sed hosted copper, where you find some, you find a lot more. And that's our expectation. These are WMC and MIM heritage tenements, have been in the company for a long, long time, and would be very difficult to get your hands on this ground today. So let's talk a little bit more about Nifty. That's really our flagship asset. Bringing that mine back into production is the center of the next few years of our journey. What you see in front of you here is basically a diagram. It's a grade shell of the Nifty ore body. Remember, we said it's sedimentary hosted. So the ore bodies are basically tabular and occur, sort of laterally continuous. You can see on the lower right-hand side, it's shaped in a syncline or a bowl shape. and it was discovered when it was sticking up out of the ground in the late 70s and brought into production in the 1990s. And there was you can see the shallow open pit that exists, there. What happened is that the oxidized copper ores that were sticking up out of the ground were mined along with a supergene blanket, producing about 220,000 tons of cathode through the SXEW plant. And then the pit stopped. And the reason that the pit stopped was because the metallurgy changed from oxide to sulfide. And so therefore, to access the next part of the ore body, you needed to build a mill. And the colors on the ore body in front of you kind of roughly correspond. The orange is 0.5% copper and above, and it's stacked and layered. So you're seeing the outside edge is orange. You can see that down where these circles appear, there's this red and violet color that's 2 and 4% copper at the bottom of the ore body. So what was developed was an open pit to go after, a deep underground to go after that very high grade area. So first ran out of material that could go through an SXEW, time to build a mill. Step 2, build the mill. And step 3, start an underground mine. So there was a 10-year operating history from the underground mine, produced 500,000 tons of copper. It's about 1.6 billion pounds of copper over the underground life. And then the underground mine basically ran out of high grade ore at a time that metal prices were falling. And the underground mine went on to care and maintenance and was later abandoned. So what are we left with after that 10-year operating history as SXEW and 15-year operating history with the SXEW copper cathode, 10-year operating history with the open pit? Well, you have a disturbed site. You have 91,000 tons of copper contained in the heap leaches that we're going to go back and releach, and I'll tell you a little bit more about that. And then we have a large reserve in the open pit. This shows you the cross section of the open pit where it stops as the metallurgy changes, and that bowl shape continues. So this is a very large ore body, 80 million tons plus at about 0.9%. And the only reason this actually still exists is because it went through that end of life as an underground mine and the transition to open pit operations. The third asset that we have here at Nifty is we actually, at the Nifty Copper Complexes, we've got a host of permits. So going back to it, above ground resource, open pit extension, we've got a copper SXEW, and then we have a mill to mine some of the open pit sulfides, and then we have all these permits. Let's look a little bit at the SXEW. So this is what the SXEW looked like in May. Over the last couple of years, there's been quite a lot of work done bringing this in a ready to restart fashion. And originally, this is a 15,000 ton SXEW that was later expanded to 25,000 tons of productive capacity. It hit that peak rate in 2004. And the work that's been done to try to bring this back into production has been to get it last operated in 2008. So quite a lot of work detailing pipe runs, electrical, scrubbing out all of the tanks and vessels that comprise an SXEW and getting ready for production. What our plans are is on the next slide is effectively to re-leach those heap leach pads by turning them over and dosing them with sulfuric acid and precipitating out the copper and then plating it in the SXEW. It's a well-known process run all around the world. And what you see on the slide in front of you is that it's basically expected to generate somewhere between 40 and 50 million Australian dollars per year, depending on what your FX rate is and your copper price assumptions. And in order to get the plant back into operating condition, it's effectively things like pumps, valves, PLC control boxes, electrical. There's not a lot of custom things that go into this to get it restarted. It's off-the-shelf procurement and then refurbishment of an old plant. So we're just starting some of the early works around that now as we close out our capital raise, and timelines on this are, between 9 months and a year to get through practical completion and into commissioning. So when we think about this is the numbers you see on the left-hand side of your screen are from a PFS that was completed late at the end of last year. The construction estimates were done at a Class 2 level, which are feasibility level. And what you see is that we basically have $30 million of development CapEx, $15 million of capitalized OpEx. So in that $40 to $45 million construction range for the project. And again, throwing off about 1 times that each year, depending on how the macros end up. So it's an extremely accretive project for us and should help us drive cash to the balance sheet and set us up as a company as we move from a developer and into operations. This is a relatively easy step. What does the project look like when this is actually up and running? It's going to be somewhere in the neighborhood of between 60 and 70 people total complement, and that breaks down into 4 shifts. So there's about 20 people working on the above ground resources at any point in time. We've got a 4-year reserve life on this. The project life extends into 7 years. And then regionally, not only within the open pit that's immediately adjacent to this, but also in the region, there's more oxide resources that we believe we can convert and put through this SXEW and either grow production or extend it for quite some time. Phase 2 is to restart the concentrator. If you go back and think about the slides that were there before, we have roughly 80 plus million tons of copper sulfide reserves sitting next to this concentrator. This concentrator here that you see last ran in 2019. It basically processes between 2.5, 2.8 million tons a year with a little bit of a push. We think it can get to 3. And that's it's been continuously electrified since it went on care and maintenance. And so right now we're going through and assessing what does it take to bring this concentrator up and running. There's also our PFS originally looked at. We've got so many reserves. What if we expand the mine and expand the concentrator and mine the resource quite as fast as we can? So we've got a $1.1 billion NAV at 425 copper and 71 cent FX. It's an extremely profitable project. And what we are looking at right now is if that's what the ultimate picture is on the open pit, how do you break that down into achievable and approachable steps and then action those steps? So I think that the first step on this is probably going to be turn on the concentrator and run the open pit, commission the open pit, and then expand into the fullness of what we think we can do from this. To put that into context, the open pit operations here on slide 11, this is a very big mine. 40,000 tons of copper in concentrate is a substantial mine that ends up being in the range of $700-800 million a year of revenue, $150 to $200 million a year of EBITDA. The life of mine cash flows and the PFS end up being in the multi-billions of dollars for a couple $100 million to get it up and running. So it's very economic. It gives you also strategically very long reserve life and a long reserve tail in a plannable open pit. And so it's a very strong basis from which to build a company and grow a company. So when you step back and you think about our operational setup, first we've repositioned the company to take that first step, build the SXEW, accomplish that, then leg our way into the restart of the open pit concentrator. There aren't very many of these mines of this scale that are left and haven't been acquired. There aren't very many of these mines globally on a brownfield nature that can be as quick as we can be to market and as low capital intensity as we believe that we can be. And so it's a substantial opportunity just from a execution investment proposition and M&A chessboard. And then I think what we've been able to do as a team has been really something to watch. In 2024, the company was still just exiting a very turbulent period where the end of the underground operations had left it with looming debt maturities and no real sense of self and no forward plans. And over the last year, we've refinanced those, the balance sheet. We've upgraded all of our resources. We've set some very simple and achievable plans, and then we've capitalized ourselves to go out and achieve them. And so what should you expect from here, from us, is basically continue down that road. So it's an execution story. We have the capital in hand. We have great partners like McMahon, which for North Americans is a 9,000 person strong mining contractor, mine operator that's helping us along this journey of cathode restart and open pit operations. Glencore helping us on the offtake. And so we're surrounding ourselves with strong partners to build a strong company. So near term, you should expect us to sanction the project and be moving that forward very quickly on the back of funding. Feasibility coming into view on exactly how we're going to approach the open pit, and then we'll go and execute that. And we'll continue to build strong partnerships around us. So the key is between now, one of the key ways to judge us is between now and 12 months from now, we'll be making that transition from developer to producer on a relatively simple project that should be very accretive. As we've talked through this, I just want to highlight, I've made some forward-looking statements. These are necessarily aspirational, or what we believe will happen may not come to pass. I'd encourage you to read the disclosures on page 14 carefully before making any investments or in light of the comments that I've made today. So with that, let me jump into the Q&A and give me a second to just get oriented. Okay, question on major milestones. So the milestones for us right now, there's four aspects. The thing that we're very focused on and is going to actually create a significant difference in the basis of our company is stabilizing the company and getting to cash flow through the cathode restart plan. There are sort of four movements to that. First, there's ponds and drainage and infrastructure that sit outside of the existing heap leaches. Two, there's the commissioning of the heap leaches, which is turning them over and receiving acid and putting them on there. Third is getting the actual SXEW refurbished and up and running. And then the fourth one is some general cleanup around the site, including some limited refurbishments of things like kitchens and air conditioners. And so, again, it's a very knowable and containable set of projects, and we're looking at these going, how can we move through these efficiently and quickly, and can we accelerate time? Our great strategic advantages here are sunk capital and the ability to move quickly, in part because of the sunk capital and in part because of our permitting status. So the sunk capital is not just steel in the ground, it's also reserve information, historic operating data, built infrastructure rather than just mills. And it just keeps on proving better and better for us as we go. So I think the main thing I'd ask you to judge us on is can we move quickly and confidently down that path to producer? Second is we want to be able to develop the rest of the portfolio, which again, with over there's 1 million meters of drilling here. It's some of the best tenements on the west side of the Patterson, and it's the growth options here are great, but we have to get stage one done. So thanks for that question. Sensitivity assumptions for copper price and FX in the pre-feasibility study, and how can that impact your free cash flow production? Look, I think that we used $4.25 US. Price today is well above that, and 71-cent FX. And the current FX is actually substantially below that today. Copper prices are going to continue to go up and down, and FX will change over the period. we have that producer's, I suppose, optimism of knowing how hard it is to bring on new units and feeling like there is copper scarcity in the in the markets. The way that we see that is in the nature and quality of some of the strategic partners and interests that we have around us, as well as, frankly, on the investor side, we feel like we've been a beneficiary of the wave of M&A that has taken away ways that investors can express a positive copper view in the market. So there's both scarcity in the investment world, but also the cupboard is relatively bare on things that you can bring to market quickly. Just bearing in on that, one of the things that's very interesting about a brownfield is that our capital intensity is relatively low, but also the timeline, because of the sunk capital, is relatively low. When you make an investment decision, it turns into results within a very short period of time. We're looking at like a year for copper cathode production, a year beyond that, maybe a year and a half to restart open pit production. That's a very compressed timeline. When you're looking at a greenfield mine, 3-4 years between when you make an investment decision and when you start to see what that looks like, and therefore the fortunes of the forward curve can change radically, much more radically, further out on the curve than near in time. Thanks for the question. Let's see. Main drivers behind the 20-year reserve life, and how confident is the company in further resource expansion? So the 20-year reserve life, I mean, on one level, there's just there's a huge amount of drilling here. There's something like 380 kilometers of drilling at Nifty. A lot of that was actually to define what you call the upper zones, which are up dip and away from the underground mine. The underground mine itself is a little bit messier, but within the whole reserve ore body, there's a tremendous amount of drilling, and that gives us quite a lot of confidence on continued resource life. Further resource expansion, well, when you look within what sits outside of Nifty, again, the mechanism of orogenesis, or how does an ore body come to be sedimentary hosted? It's basically usually when you see sedimentary copper, it's a district. It's not just one area. And some of the hits that you see in the outlying areas that have been covered through time show ample evidence of economic grades, here and there. Just hasn't been followed up for a long time. And so that'll be something that we would look forward to doing, particularly when we're through the first phase of execution. Thanks for that question. How do you get in contact with us? I think probably the best way to get in contact with us is through the communications inbox. We've got a team monitoring that over time. So it's communications@cypriummetals.com. You should be able to find that. Also, you can find that in the tail of most of our public announcements. And top two risk factors. Well, there are the things that we can control, and there's the things that we can't control. So most of the things that are within our control, particularly with the SXEW restart, are relatively knowable and well in hand. When we just raised $80 million, and to be fair, the final tranche closes next week on the back of a shareholder vote. This presentation is in a little bit of an awkward time because we're in between closes, so we don't have a pro forma balance sheet, but the company has debt associated with the turbulent timeframe that it came through. So there's a $40 million senior loan currently outstanding, 42.7 Australian, 27.5 US. And then there is a convertible note that you should think of as subordinated debt. And that total is nearly $80 million. We raised nearly $80 million. Those maturities on both of those debt instruments are further out in time, 2028, giving us the chance and opportunity to get ourselves to cash flow. But specifically, when we were trying to think about how much money did we want to raise in order to be able to execute our timeline, we're anticipating paying down a pretty meaningful portion of our debt with the funds that we just raised. And so the balance that we're seeking to maintain is being funded with surplus to be able to handle the shocks and bumps that come with you, and then also the cost of the turbulent past, which is still on our balance sheet. So I think that in terms of so that's the debt on a pre-revenue company, that's a risk. I think that's why the company has been trading where it had been trading, and that the financing that we've done has been such a big unlock. So we're trying to manage our balance sheet risk. Copper price at the moment seems to have a positive skew, but that could turn against us. So those are, and then the other one is execution risk. Can we actually do our jobs? And the way that we've tried to mitigate that execution risk is by surrounding ourselves with the very best-in-class partners we can at every turn. And I think that one of the things that's very interesting about Nifty Copper Complex and kind of the brownfield nature of copper is that we're able, and the location in Western Australia, is we're able to find great partners who can get there in a single plane flight from where they live. They're operating in the area, they understand the area, and it's actually a huge silent de-risker to be operating in this theater so close to so many centers of excellence. And therefore, we can't take credit for de-risking being in Western Australia. But if execution is a risk, being at First and Main in Western Australia and having access to the types of partners that we have, that's really been how we've been trying to address that execution risk. Not only who do we have on our team, but also who do we have around us. It's an exciting story. Please reach out if you'd like to learn more. We are definitely open to one-on-ones, and just ask you to follow the story and continue to think of us when you're thinking of near-term copper opportunities. So thanks for all your time and attention.